After repaying billions of dollars in U.S. government bailouts, the nation's largest banks are making profits again. But President Barack Obama says some of those profits are the result of risky investments, the kind that forced the government to provide banks with billions of dollars last year to rescue those considered too big to fail.
Banks will no longer be allowed to own, invest, or sponsor hedge funds, private equity funds, or proprietary trading operations for their own profit, unrelated to serving their customers.
Without new reforms, the president said the risks that brought on the financial crisis could result in another economic disaster. Reaction on Wall Street was swift. The Dow Jones Index plunged more than 200 points Thursday after the president's speech. European and Asian stocks followed. British financial analyst David Jones described the measure as drastic and said it was unlikely to pass.
Personally, I can't see it going through exactly how he's outlined, being maybe as draconian as he proposed. And it does seem at the moment, by the market's muted reaction today, that the markets may be a bit sceptical that this will get the full sign-off a few months down the line.
The proposal comes amid growing public frustration with Wall Street as bailed-out banks continue to restrict lending while imposing higher customer fees and paying executives large bonuses. Testifying before the House Financial Services Committee, Columbia Business School professor Joseph Stiglitz said the reforms were badly needed.
We may congratulate ourselves that we have managed to pull back from the brink, but we should not forget that it was the financial sector that brought us to the brink of disaster.
But some analysts say there may be unintended consequences. Pension fund analyst Raji Menon.
Pension schemes are big investors in global markets, so this could mean that their assets are reduced as a result of today's fall. So at the end of the day, pensioners or ordinary consumers will be hit by Obama's proposals.
Some economists believe the sell-off in global stocks is just a reflex, and the move is not likely to have significant or lasting effects on world markets. Large financial firms, including J.P. Morgan Chase, Citigroup, and Bank of America, likely would be the hardest hit by the president's reforms. Shares in some banks have declined as much as 5%. Arcega, VOA News.